What is revenue recognition and how does that change across industries? Well, to start with, revenue recognition is done through numerous methods. That is, accounting or the generally accepted accounting principles allow businesses to record revenue in a way that corresponds with the business activities that they undertake. Some of the more common methods begin with the completed contract method. That is, you don't record revenue until all of the obligations that you have pursuant to a contract are completed. Okay, another method would be the cost recovery method, meaning that you allocate expenses or you allocate resources toward a contract, and these are expenses to you, and you do not begin to recognize revenue until you've recovered all of the expenses that you've invested or spent towards this contract. Another method would be the installment method, and this is generally in industries where you have payments along and along towards a greater contract. They're divvied up into recognizable units, so you would only recognize revenue once you've received that installment of resources coming in. Another method would be the percentage of completion method. That is, you have a contract that you are completing along and along, and you would record revenue based upon the percentage of completion. Now, this method generally has two acceptable approaches, the input method and the output method. The input method meaning you measure your percentage of completion based upon the extent to which you've input the effort necessary to achieve the contract, or perform all the obligations under the contract, or the output method, which is based more upon how much of the contract is complete or how much of the benefit has been received by the recipient. So it's more looking at, these two methods are looking at different things. How much you put in, or the percentage of effort required to complete the contract that you've put in, or the output, the percentage of what the customer or client expects that they have already received. And then the sales-based method, where you record revenue at the time that a sale takes place, at the time that there's a transfer of ownership or title to whatever product or value that you are selling or delivering. So this is the sales-based method. Now, the rules that govern any of these methods that are being employed fall under Revenue Recognition Standard ASC 606. Now, this is not just a single standard. It is a broad standard with lots of sub-provisions that provide all of the rules related to how and when you recognize revenue for accounting and reporting purposes. Now, there are several steps that provide general guidance to companies. So any method that's employed must meet or comply with these identified steps. First, identify the contract with a specific customer or client. So no grouping together. You identify whatever the project is and identify the contract to which revenue will be attributed. This brings up issues when you share cost among multiple contracts again, and you could see how in these different methods this could become confusing. So once again, identifying the contract to which you are working for a specific customer or client. Part two, identifying the performance obligations that are relevant to this contract rather than general efforts that are again combined across multiple contracts with different customers. Okay? Determine the transaction price. What are you being paid for? What amount of value is being transferred to you in exchange for value rendered? So any contract is going to have some level of identifiable value exchanged by both parties. Most notably, there's going to be money involved. Generally, the customer or client is paying for performance. So you identify the amount of money or the value exchange relevant to that particular contract. Okay, then you allocate the transaction price to the obligation as closely as possible. If it's busted up into different installments or divided up into performance segments, then you would be able to allocate certain elements of that price for performance to those different elements. Now, are there things in there that are related to cost recovery? Yes, they still are, and you can fit these other methods within this approach. But as long as you identify the price to the collective obligation under the contract, then you're complying with this rule. And lastly, you're going to recognize the revenue whenever you perform the obligation to which the receipt of value is tied. So even if you've been given money in advance to perform an obligation, if you have only earned that money based upon the completion of some portion of the identifiable obligations under the contract, it is when you complete that obligation is when you would actually record the revenue. So in summary, this is the framework by which any business is required to adhere when they are recording revenues. And of course, different industries are going to have different approaches to how contracts are formed, the nature of obligation, and things like that. But as long as you keep this baseline in mind, you'll be in compliance with the accounting standards.